With us is CNBC contributor Peter Boockvar. He's the chief investment officer at Bleakley Financial Group, along with our very own Dom Chu. Both of you, thank you for being here. Peter, what do you make of this?
So yields are back to where they were right before SVB collapsed, when the market assumed that the Fed was going to continue to raise rates. And then, of course, what happened with the banks, that dissipated. And now we're right back. But back then, the S&P 500 was around 4,000, 4,100. Here we are, 4,400, with really no change in earnings expectations relative to then to here, on the cusp of an earnings season. That's going to be, I think, an interesting reality check.
Is that a sign that investors are confident that the banks have cleaned up their act and that there are no more problems out there? Or is it just sort of the narrative faded and we've moved on and it's attention deficit disorder marketing?
I think there's some confidence that we're not going to see any more major bank failures. But I think that the confidence is dissipating in terms of the economic impact of higher interest rates and how banks have reined it in terms of credit extension. And it's not just banks. It's the IPO calendar, notwithstanding a few over the past couple weeks. It's VC funding. It's leverage loan funding. I mean, there is a credit dry up that's happening where the government essentially is crowding out the private sector because people are putting their money in treasuries and money market funds.
Dom, you were talking about the bond market at the top of the show. We had Diana Olick on talking about housing, mortgage rates at 7%, that being sort of the new normal right now. Boy, you wonder what that means for buyers.
It's not, I mean, the interesting part about the housing dynamic right now, and it's something that Diana has spoken a lot about, is interest rates are at very much the center of what's going on right now.
Yeah.
But the real estate market is right now constrained because there just aren't deals getting done. There's no supply of housing out there. Those people who are in homes and are already borrowing to finance them are staying in those homes.
I'll tell you what, I've done almost no smart financial things in my life, but one of the ones that I did was refinancing at 3% in December of 21.
Right. If you've got a 2
I think
or
I'm
3
living in that house until I die, right?
Correct.
I mean, there's no way I can sell.
You're not the only person who feels that way. And so it's also changing some of the way that demographics work, because normally what you have people doing is when their kids kind of get older and leave the house, they might downsize, right? They might try to find something smaller, cash out, and go somewhere else. Yeah. The problem right now is there's nothing to move into. And even if you did and you had to borrow a little bit more, you're borrowing at much higher rates. So it's changed the entire, even in some of the neighborhoods and suburban metropolitan areas where schools are important. If you look at the dynamic there, it's curious, right? Because people are no longer leaving their homes once their kids get out of school. They're staying there.
They can't afford to downsize.
They can't afford to downsize. Which is crazy. Which is a little bit weird. So there's a very shifting dynamic right now. And I'm not sure that it's straight just because of rates doing what they're doing. There's also a change in behavior.
But, Peter, this is what the Fed wants, right? They want to see this kind of change in behavior. Otherwise, they wouldn't be raising rates.
Well, textbook-wise, you raise interest rates, you slow down the housing market. You see a decline in home prices to mitigate the rise in mortgage rates. We haven't seen that. Home prices have not fallen as mortgage rates have. So the housing market is actually sort of upside down from that perspective. So the Fed's actions, and you go back over 20 years of them keeping rates low that juice the housing market, the housing market's actually kind of not doing what they wanted them to because home prices are not falling. We're not loosening the opportunity for people to buy homes because home prices are high, mortgage rates are high. It's almost a stagflationary situation in the housing market.